Hello and welcome to the market update for Tuesday, March the 29th. If you have any questions during the week or any questions I don't get to during the class, make sure you send those to jerry@traderspro.com. And let's go ahead and get started with the update here. Now, obviously, the market has continued to move higher. It's unusual to get this type of a run in such a short period of time, and because of that, like I said, it's led to reservations for me to jump in and I feel like I'm chasing the move. Well, today we finally are getting a little bit of a bearish reversal candle that's showing up. So despite the indexes being up today, there's a little bit of a warning sign there, and there are some other indications that we could get a little bit of a pullback. Now, it may just be a pullback. I'm not suggesting that we're about ready to fall off a cliff or anything, but just be aware of that. I'll show you on the charts here, and we'll go over a few things. I'm also going to talk a little bit about the possibility we could get that we could get an inverted yield curve. You've probably heard a lot about that, or people mentioning that today. I'll briefly talk about what that means, just for those that may not understand what that is and what the ramifications of that are. Although, again, as trend traders, we don't get too caught up with some of these things. It doesn't really matter, especially with an inverted yield curve, because an inverted yield curve can happen and it could be months before you see a recession, and the market could be trending in either direction just based on however it's trending. And so we don't want to get too caught up with some of those things, but it's important to understand kind of what's going on and the significance of what's going on to help you in your analysis, because it can be a factor in your analysis, not the factor, but a factor in your analysis. Looking at the direction alerts, though, one thing that is bothering me a little bit is, and it would be expected, as you see that as the market has shot up, you've seen momentum now get into the extreme reversal risk area here. But as you hear me talk about a lot, what you want to see is breadth there along with it, and we're not seeing that. Breadth is still in the trending range. It's not even in the buy range. And so immediately what that's telling me is that the market is rallying on just a few stocks. There's not a broad-based rally going on, and it's become more so over the last week, because remember last week there was a little bit of a gap there between the breadth and the momentum, but not near as big as it is now. So really over the last week, we've seen a big surge in momentum, lack of a surge in breadth, and that concerns me a little bit. That's usually what you see towards the end of a run, and so we now, again, I'm not suggesting that this is the end of the run here, because it just could mean that we go into a little bit of a pullback or correction. And that correction could be a pullback, or it could be moving sideways too. It doesn't necessarily mean it has to pull back, but that there are a few little warning signs kind of taking place here. Sentiment is moved into the extreme range, so sentiment is getting high for our comfort level. But it's been elevated again through most of this move anyway. So we're not seeing we're just barely entering into the extreme area. We're not seeing extreme complacency yet. But it is worth noting that has entered the extreme range. And that's the same with momentum here. We've just entered into that extreme range. It can usually it's when it gets past the halfway point, gets over to the right side of the halfway point, that you start to really notice that it's really extreme. And the way, like I said, with the way the price action is today, it looks like we could pull back a little bit. It could just mean that we're going into a correction. We could see this move back this way a little bit, but and a correction is good here, because that would then if we can see how things correct, if we don't see any panic selling taking place, it just pulls back in an orderly fashion, it means it's going to create an ideal entry point. And finally, we'll have a good entry point to start getting a little bit more aggressive with our portfolio and getting into new trades. So we're getting closer to those more ideal conditions that we've been kind of patiently waiting for the last month. Buy-sell ratios they're not overly extreme here. Buys are outpacing the sells, but as you can see, they're not too wide right here. I am a little concerned with the second sentiment indicator over here that we're getting close to that red line right there. We're not quite there yet, but that tends to be an area where we get pullbacks is when that sentiment indicator gets up near that red line. It can go above it, as we've seen in the past here, but when it gets up close to it, sometimes it just has to get close to it before you see some of these little pullbacks. And so we're definitely an area where we have elevated sentiment where we can see a little bit of a pullback taking place. We'll just note that. Now, talking about market breadth, you can really see it if you go into the indexes tab right here. And another thing I've been telling you to keep an eye on is the buy-sell ratios of the different indexes. As we get closer to double digits, it is telling you that those conditions are getting a little bit overbought. And what you see here, S&P 500, you're at a 9-to-1 ratio. That's 9 buys for every 1 sell. So you have 225 buys versus 25 sells. Almost a 2-to-1, almost a 10-to-1 ratio there, getting pretty close. The Russell 1000 index right here is it's not quite there yet. Nasdaq 100 though is clearly in double digits. This would be your tech heavy, 45 buys versus 2 sells. That's pretty extreme. But really noticeably lagging is the Russell 2000 right down here. You're not even at a 2-to-1 ratio there. So this clearly shows that there's been a high participation in the large cap tech stocks and very little participation in the small caps. Now, why is that significant? Well, there's 2 ways you can look at it. You can say, well, Jerry, all that means is that the small cap money is going to start pouring into the small caps, and they're going to start taking off, and we're going to see all these small companies that we traded last year that start taking off again, and they're going to start catching up. That's definitely a possibility, and that's always the problem is that when you see these divergences like this, you have to, you never know, is it leading or is it following? Are the small caps following the Nasdaq 100 and they're going to play catch up here? We're going to see them take off. That could happen. That does happen in the markets. But remember what I always tell you, though, why we even look at the Russell 2000 is that generally it tends to be a leading indicator of the market. It tends to lead the way. And so when you're rallying and the small caps aren't participating, again, you start to see why I don't trust the rally as much. It's been ingrained to me over the years that when I see that, it's like, uh-oh. By the way, this goes back to, remember several weeks ago when I'll talk about this when we get to the charts, because it really is, you'll understand why the outcome I wanted was so important, and when we didn't get it, why it causes me to be very concerned. But anyway, so that's something to continue to watch here. And like I said, it's possible that we do see the Russell play catch up. But if we don't, and we see it start to roll over and start dropping, then that'll kind of confirm what we're seeing with some of these numbers here. Now let's go right to the charts here. And what I was starting to say, but I held back here just because I wanted to show you the chart as I'm talking about this. Remember back here, what I was hoping for back here was to get that flush out move, that final drop, that panic selling, that bullish reversal, maybe a big gap down, kind of similar to this, where you get a big gap down and then it closes higher than where it opens. The reason why I wanted to get that is because, again, if you don't get that flush that flush out sell off, then it's hard to trust the rally. It's hard to know if you haven't had it yet, you're about to get it, and the rally is just setting up for it to happen, or if maybe it is done, maybe it is over. There's too many question marks, and so again, that's what led to as we started to rally up right here. The first part of that rally, you just couldn't trust it because you're waiting for it to roll over and have that big move down. In fact, you probably, if you went back and reviewed one of the recordings back there, I was probably pointing out that it's possible that this little rally was wave A, this is wave B, and this is just wave C, and we could possibly roll over and have that big sell-off. And so it just creates more uncertainty, and then the more uncertainty you have, the harder it is to make your trade decisions, because nobody wants to be the one that's buying in on a suckers rally or getting caught up in whipsaws in the market where they're buying and the stock they buy immediately goes down and they get out of that one and they get into another one, or they short a stock because it looks like the market's going down and the market rallies. That's a lot of that can happen in these types of market conditions. And so the reason why I wanted that so bad is because I would have a lot of confidence in at that point, and I would be buying right at that low, right at that flush out low, right when everyone was panicking. And as we kept rising, that would be confirming that we're in a nice strong uptrend and we're going to keep going with this thing. And it would just allow perfect timing into the trades. But as I lamented at the time, the market doesn't always do what you want it to do, but you're experiencing exactly why I wanted it so bad, because this is the type of condition you get into if you don't get that clear signal. Now it could be that there's enough people nowadays that are looking for the same thing, that flush out move to buy into, and that the market is going to throw everybody a curve and not give everyone what they're looking for. The market has a tendency to hurt the most people as possible, and so too many people are expecting the same thing. It often doesn't play out the way everyone's expecting it to. But anyway, I just wanted to go explain why that was important to me back then, and what we're experiencing right now is exactly what tends to happen when you don't get that clear signal. It tends to just create a lot more uncertainty. So I mentioned earlier that we're getting a little bit of a bearish reversal candle today. Obviously we've been moving up, and if you'll notice in a lot of these moves, we either gapped down at the open, or we traded a little bit lower early in the day and then rebounded higher through almost all of these moves. Today was the first day where we had a clear gap up, and here's where we opened. We did try to run up a little bit higher, but as of right now, we're trading a little bit lower than where we opened, but still higher than the day before. Now, this type of price action, as I mentioned many times, is bearish. It is showing, if all you're looking at the index is just at the indexes, you're saying, the Dow's up 200 points, and you can see up here, SPY is up, 0.5%, 0.46%. If that's all you're looking at, you're not seeing what actually could be going on. And as of right now, we're trading lower than where we opened. And this is as of right now, this is an indecision candle. We call this a spinning top. Now, a lot can happen between now and the market close. That could change. That could look different. But what that's telling you is that we've gone up. Here we've gone almost parabolic, and then we get this indecision candle. usually means you're going to get some sort of a pullback. And that just may be just a little bit of a pullback, and then you're moving higher again. And that's going to be important to us. We do want to see how we pull back. If we start selling off and having a big panic sell off and really start working our way back down to these lows again, then especially if the first part of that is really sharp, we get a really sharp move down, we're probably going to come down and retest these lows or break below these lows. Now, if we do get over the next few days, get some selling, but it's kind of down a little bit, and then we try to rebound and maybe we're back and forth, it's a little bit more choppy, that'll be very bullish. That'll tell you that all we're doing is correcting this move, and we're just we're consolidating those gains a little bit and getting ready to make another run again. And that'd be very bullish for the market. So how we pull back in this area here, and it's possible it tries to move higher again. Sometimes you'll get these reversal candles, but you'll get one more move higher or attempted move higher. Here's a similar example. You got a spinning top there after a pretty sharp run up. It tried to move higher again the next day, and then after that and this wasn't much of a pullback here, but sometimes these are early warning signals. Maybe we do the same thing here where this pulls back a little bit, we try to run a little bit more, and then we get a bigger pullback like this. These are things that can happen, but we do want to pay attention to the context of this. And this is not an area where you don't want to be buying into that type of price action. You hear me say it all the time, and I was saying it during this move. I'm like, there were parts of this move I just didn't really want to buy into. I did have sectors I wanted to get into, and I did. But I said, don't worry about missing out. It'll give you another opportunity. If all we do is pull back a little bit and then start moving up again, it'll give you another good entry point into the uptrend. If we do have a big sell-off down here, maybe we'll get that big panic sell-off reversal that we could have a lot of confidence buying into and do very well. And so, we're going to get another chance. We'll get other opportunities. And so don't lament that you missed the move. There wasn't I like to look back on moves that take place and say, were there signals predicting it? And if I can't find signals that were predicting it, then I don't worry about it. I don't worry about missing out on it, because if I would have participated in this, it would have been because I was guessing. I was just going to guess that it was going to go up from here, and I guessed right, and I looked smart because I guessed right. But realistically, that there was nothing there that was signaling that was going to take place. And what I like is, I don't like to feel like I'm guessing. I like to feel like, hey, there were these signals ahead of time, and these signals did exactly what they were meant to do. It told that the stock should go up or the stock should go down. And this is one of the bearish signals right here. What would give me confidence is if the market does pull back off of that, because it's doing exactly what that signal is suggesting. And we just didn't get that down here, at least enough of those strong signals to indicate this move. So I don't worry about missing it. Let's see if we get enough signals on the pullback. If this does pull back in kind of that choppy fashion, let's see if we get enough signals that could indicate that it's going to move higher, and we could jump into this next phase if that's what takes place. So we'll watch that now. I also do want to point out, though, that today's move was significant in the fact that we broke out kind of the final area, resistance area that I said to keep an eye on, going all the way back again to this January 10th reversal day right here. We had that reversal day. I told you this was significant because we rallied, we reversed off of it, and we broke through it. We rallied up to it here on the 2nd of February, again on the 9th of February, and then it rolled over from there. I said, there's been these different phases as we've been working our way back up. One of the last ones was to get above this high right here. We did get above that one. Another one was to get above, this kind of support area right there. We got above that. And with today's open and gap up, we did clear above that. Now we might end up closing right at it. And that's something I'm going to look at as far as where we close today. Do we close right at this area here? If we do, and really what I would look at is look at this January 10th low. What is that low? Let's get a number here so you can kind of see if it closes at that number. The low of that day was 456. We'll say 456.60 to round it. See if we end up closing, and where are we at right now? 458.02. So it doesn't have to close exactly at that, but we get a bearish. Well, I do think it's significant that the intraday low today was pretty much right at that level. So if we do end up closing at the lows of today, I think that would be a pretty significant close. Not to mention, it would also change this from a spinning top candle, which it is right now, to a shooting star candle, or more of a shooting star candle, where both those are bearish reversal candles, but I think that would be a pretty significant close if it were to do it. Not to mention the fact that if it were to drop into the close as opposed to rally into the close, which we've seen a lot lately. We've seen a lot of rallies into the close. All right. The Dow chart, kind of the same thing, bearish reversal candle. NASDAQ 100. Now it is higher than where it opened, but it is still considered a spinning top candle formation. I think what's significant about where the NASDAQ 100 is that it hasn't cleared above those key areas. We're still below it. That January 10th low. This was the February 2nd. Remember, the February 9th didn't get up there on the Qs. That was a bearish divergence on the Qs that day. Didn't quite get up to that area there, but so we'll see what the reaction is there. The indexes themselves are in the extreme overbought condition, and we're kind of getting to the right side of that extreme. So again, in this condition here, it's still possible, and I showed you this on the S&P. It's still possible we could go higher again tomorrow, or try to go higher again tomorrow. But we're at a stage right here where it's much more likely we're going to get a pullback than a move higher, and so you have to ask yourself, is it worth the risk of jumping in here on a bullish trade? Is that extra dollar profit worth the risk of dropping? And sometimes it tends to drop a lot faster than it rises, and so it's real easy to end up with a $3 loss trying to get that extra $1 gain. And so this is usually, if I'm in positions, this is usually a condition where I start to take profits off the table, or tighten up stops. And I just try to avoid getting into new bullish positions. I tend to just try to avoid that. All right. Now I was going to go back and show you that. So the S&P is in that same extreme range as well. That's the SPY. That was just another clue, another thing worth noting. We're stacking all these things up to try to get an idea of the conditions we're in. Now, the Russell 2000, it is breaking out of a key area here. Remember, this was the area I told you to watch right in through here. Again, that was that long-term support from all of last year. Taking these lows right here. Well, we have moved above that today, so that would be a little bit of a bullish signal there. And the Russell 2000 is up a greater percentage than the other indexes. So could it be that they're starting to play catch up, and maybe the trend is going to continue? We're going to see the breadth start to pick up. That's possible, and that's something to keep an eye on. And not seeing we did gap up here, but we're not seeing any sort of bearish reversal on that candle. Again, I'll take another look at it at the close to see if it's showing any weakness there. But That is worth noting, that it is possible that maybe we're going to start seeing more of the rally over the next few days coming from the Russell, and maybe we'll see the NASDAQ 100 have a down day where the Russell 2000 will be up, the NASDAQ 100 will be down, or something like that. We'll see a little bit of that back and forth maybe taking place. We'll see. But you can also see that, remember, the Russell hasn't been really participating in the rally that much. It's been moving sideways through here. I mean, just look at that, and then look at the Qs. See the difference that they were moving sideways, the Qs were taking off. Maybe you see the opposite. Maybe you see the Russell take off, and you see the Qs move sideways. Now, that would be very bullish if that happens, because that means that there's a kind of a rotation taking place, that you're not seeing the whole market selling off as you would in a big sell-off, a panic sell-off. You're just seeing money come out of big cap tech and going into small caps, and so that, again, that's what we're watching, and again, we'll have an idea on Thursday. We'll review this again on Thursday and see if that's what's kind of taking place. We should have a little bit of a clue by then to see what's taking place off of today's move, and we'll watch for that. All right, the bond market. Is, again, it's been oversold. The yields have been going higher and higher and higher. They were at that extreme reversal risk last week, and I told you that we probably would get a little bit of a bounce. We got a little bit of a bounce, went a little bit lower again. Now we're getting another bounce. So we're just kind of consolidating that oversold condition. It could, I mean, we're still in the downtrend. We did end up going lower right here. So technically this is a lower high, lower low situation. If we get above there, that would give you a first higher high, although I still probably look at this one right here, get above a couple of these lower highs would give me a little bit more confidence that maybe you're in a little bit more of a trend reversal. I don't see that yet. So again, until then, I'm assuming we're still in this downtrend. We're still going to continue in the downtrend. Now, this brings me to a discussion on the yield curve and what the yield curve means. Now, we're not going to look at this on Traders Pro, but you could look. There's a free place you can go to look at bond yields. You can just go to CNBC and go under. You could go into this tab right here, and under markets, go down to bonds. It'll bring up the bond yields, U.S. Well, it'll give you all the bonds of different countries as well, but we'll look at U.S. Treasuries here. Now, the main one that most everyone looks at and agrees upon are the 2-year and the 10-year yields to see if they invert. Here's the 2-year. Here's the 10-year. Now, but you're hearing a lot of people talk about looking at different ones, and it can get really confusing when you start, having everyone. It's like moving averages. There's one of the most common moving averages that most people will look at are a 50-day moving average and a 200-day moving average. But then you always have people that come on and say, well, I don't look at those. I look at the 30-day moving average or something. They all have their little quirky system that they use, and so be it. When I try to so when I try to have a discussion on these things, I try to focus on what the general consensus is. And when you're talking about the possibility of a recession or what could signal a recession, most everyone's going to be looking at the 2-year, 10-year yields. And typically what's going on, or typically the yield, the longer term yields are going to be higher than the shorter term yields. And that is the case right now, that the 10-year is at 2.39, the 2 years at 2.37. It hasn't inverted yet. But when they say an inverted yield curve, what will happen is that this yield curve, this yield will go lower than the shorter term one, than the 2-year. So it would flip flop where this might be 2.37 and this might be 2.39. Now, the reason why it's kind of as trend traders, the reason why this is ridiculous to even worry about this right now is because when the yield curve inverts, it can be several months before a recession shows up, if it does at all. Okay, not every time that the yield curve is inverted have we gotten a recession. However, with every recession, we have had an inverted yield curve. So, it's a pretty strong indicator that if we're not going to get a true recession, we're going to get a slowdown that's usually going to be pretty painful. Okay, but the key to keep in mind is that this could be the actual recession or the actual main results of the slowdown could be months away. So really, as trend traders, this doesn't really matter to us, okay? However, it does matter in the fact that here's where it would matter for me. The only way this is going to matter for me is if I see a trend, a downtrend forming, or the possibility on the chart showing that the market should be moving lower, and we have an inverted yield curve that would suggest the recession is coming. Because then I can use that as saying, okay, that's another reason, another clue to trust this downtrend that I'm seeing on the chart right now. Okay, that can give you a little bit more confidence in that trading that downtrend if I'm going to trade it. If it also has, if we can also see this inverted yield curve. But if the trend is up, if we get a little bit of a pullback here and the market looks like it's going to go higher again, I could care less if the yield curve inverts, because the chart is saying the market should go up, and that's what I put the greatest emphasis on is what the chart is telling me. Okay, does that make sense? So we can look at this as a possible reason to be bearish if we see a downtrending market. It can be another one of those clues to make us bearish. But if we don't see a trend moving down, the trend is moving up, trade the trend. Don't be shorting things, and especially don't be thinking the world's coming to an end because the yield curve is inverting. Okay. But if you want to keep an eye on this over the next few days, just for anything, just to see it in person, have this experience of being able to see the yield curve invert, you could just use CNBC and just go to the bond, look at the bond yields, and you can watch that all day. In fact, I think it came pretty close earlier today. It might have even inverted earlier today. I don't watch it, but you're going to hear a lot of people talk about it. And if you didn't understand why they're talking about it, hopefully that helps a little bit, and why it could be significant. But like I said, we're not going to put too much of a focus on it in our day-to-day trading. All right, moving on here. If we go to gold has taken a little bit of a dip. Not too surprising though. We had this kind of impulsive move down. I talked last week about this being a potential, looking a little bit more choppy and sideways, looking more like a bearish ABC pattern right here. And since then we've gone lower. Although today is a bullish reversal candle. So maybe the selling is done and it tries to rally, or maybe this is all still part of the correction. Maybe this is wave A, wave B, and you get a rally up here for wave C. So short term, this is showing a bullish price action, but the trend is acting like a downtrend with the lower highs and lower lows. I think that was a slightly lower low on my intraday low there. So in order for me to be a little bit more bullish on gold, I'd like to see it work its way back up and go to a higher high right here. But like I said, in the very short term, at least if that's the way it closes today, that would show that the short term it should have a little bit of a bounce, at least right here. Oil is doing the same thing. It opened lower today. Now I'm a little bit more. We had a big drop Friday or yesterday, and I got out of I got out of all my oil stocks on that move because I became concerned that maybe this is wave A, wave B, and we're going to get a wave C coming down a little bit right here. Now we did get a bullish reversal candle, but again, these are very short term in nature. It could just mean that we try to rally a few more days and then we come down. It's possible it goes right back up again. One of the things that you have to be aware of that could be causing a little bit of volatility in energy right now is there's the rumors that there could be a ceasefire agreement. That's been the talk today, and was part of the reason why the oil market sold off early. Now, I haven't followed it closely, but as much as I've been following the whole conflict, and I just don't see Putin. I could see him acting like he wants to do something and get a ceasefire, but I just can't see him doing it. At least not yet. And so that could just be a short-term thing that the market is reacting to. But anyway, that's the part of the problem, though, when you're waiting on these news events like that, is that they could go either way. And if there is a ceasefire, you could see oil come way down quickly, especially as much as it's run up. Although if there isn't one, I don't see oil spiking dramatically. I can see it working its way back up again. I don't know that it would start spiking, especially since we had a lower high right here. And this spike was a larger spike. This was a smaller spike right here. Maybe you only rally for a couple days, and now if we can break out above here, maybe it's taking off again. But and this is what makes it difficult when you don't have that normal stair-step pattern that's developing. When you start getting impulsive up, impulsive down, impulsive up, impulsive, it's hard to know what. It's not really predicting where the next direction is. Not predicting it very well, and so I'd really like to see it kind of get back to kind of that normal impulsive corrective alternation there. To have a little bit more confidence in that. But anyway, that is we did open lower today, but that is a bullish reversal candle. Should have a little bit of follow through, at least in the near term. It should move up tomorrow off of that. But again, if that was guaranteed, though, I'd trade those all day long, and they don't always work. But there's a pretty high probability off it. As long as it closes that like it is right here near the highs of the day, there's a pretty strong probability that it'll at least open up higher tomorrow based off of that. Now, the dollar did the same thing. It had a big gap down, and it's having a bullish reversal candle. Again, it makes me nervous when you see commodities and the dollar moving the same direction. What did I tell you earlier? When that happens, it tends to be a recessionary signal as well. It tends to signal potential slowdowns coming. So if we're seeing that relationship happening again, and the bond yields inverting, that would be concerning. But it did find support at the lower part of this. So I still am looking at this as a sideways correction in the dollar. It should move up off of that. We'll see what happens. But if it continues to move higher and commodities continue to move higher, again, that would be we can't ignore that signal. We got to pay attention to that, because that could mean that they're that the rally may not last very much longer, and we could see a bigger correction coming. So VIX has come way, way down, and that was more of a bullish indicator. I talked about this last week, that the fact that the VIX has come way down is one of the reasons why I've put a little bit more trust in the rally that's taken place. Now, again, we're not at the close yet, but this is possibly a little bit of a hammer candlestick forming here. If we get a little bit of a sell-off into the close and this rallies up a little bit, it would look more like a hammer candlestick formation, and that would be bullish, which would be bearish for the market if that takes place. I'm not trying to look too much into that, although we did get a gap down too, a big gap down with the gap up in the markets. That's just usually not. You don't ever want to chase when the market's been moving up. Then you have a big gap up like we had today. You just never want to buy into that. It's just that's a big red flag, and usually not going to end well. In fact, I had some call option trades I got into yesterday, and I got out of them immediately at the open. Probably could have waited a little bit longer to get a little bit bigger profit on them, but when I saw that market gap up and then we start trading lower, I'm like, what's gonna push these stocks higher? It's like I might as well just take what they gave me overnight, because it's much more likely we're going to see a little bit of a pullback soon. So, but this is also something we need to watch. If the market does start selling off, we start seeing spikes up in the VIX. We're still well below the warning area, the area where market's kind of freaking out. So I wouldn't anticipate that I don't see any reason from the VIX standpoint I don't see any concern in the market right now based on what the VIX is showing me. Bearish, this is the chip sector, SMH, do have a bearish spinning top candlestick formation there. This tends to be a little bit of a leading indicator, especially for the NASDAQ 100. So you had the Qs that had a little bit of a spinning top, but they were trading higher than where we opened, but the chip stocks are trading lower than where we opened. Either way, that's the same indecision candle. Doesn't necessarily mean it's got to reverse and come down, but in the context here, it would show a pretty high probability that you get a little bit of a pullback there. Dow Transport's kind of the same thing. It ran a little bit higher here. It's come back down. It's a little bit stretched in that extreme reversal risk area. And finally, Bitcoin. Now, the area I was telling you to watch on Bitcoin was to see if it could break out above this area right here. And it has. Now, the actual Bitcoin chart is actually cleared this area a lot better than this stock has. And again, all these stocks that we use to kind of as a proxy to trade Bitcoin, they're not always going to look exactly the same as the Bitcoin chart, but at least it's one that we can kind of look at. And we did break above here, so that's a lot more bullish now, because now it looks like we've held the support, and now we've gone to a higher high for the first time. And so I would expect that Bitcoin, at least as of right now, is acting like it's starting to trend higher again. So we'll see if that continues. All right. Now with the update, then having gone through the whole update, I don't really want to be jumping into any new trades. I will point out a few though that we could, from the watch list here, that we could keep an eye on and continue to watch. All these oil stocks. It'd be nice if they could pull back a little bit deeper, but they might give you some, kind of a second chance to get into if you missed the last one. Actually, before we go through this, Let me go to the portfolio here real quick. So I got out of a lot of the trades, and I'll have to take a look at some of these. Let me go through though. And I told you the way I manage. I try to manage a portfolio. What I try to do with the portfolio is teach you some different ways you can manage things and some of the techniques that I'll use. Like I said, it's hard for me sometimes if I see a bearish candlestick formation and I know there's a great chance that stock's going to pull back. It's hard for me to just give up the profits I've made, knowing that that's coming when I know that I could probably get out and then get back in again. Now, I get it that there are tax implications to some of this stuff as well. I just decided long ago that I wasn't going to trade based on tax decisions. I made a lot of mistakes early in my trading career because I failed to take profits because I didn't want to be taxed on the profits, and then the profits turned to losses. And then guess what? You could use the losses now to write off some of your taxes, but who wants to do that? So I just decided I'm just gonna be happy to pay whatever taxes I have to pay on these things. It usually means that I had a profit then, and so I get it that some of you don't want to be jumping in and out of things for that reason, and that's why your trade management technique is going to be a little bit different. You might want to wait until it goes to a sell signal to get out, or breaks to a if it's been stair stepping up, wait until it goes to a lower low or something to stop out. Try to stay in not have to jump in and back and forth in as much. And I'll probably get more to that where I'm letting it run when I have a little bit more confidence in the longer term trend, which I just don't yet. I'm not going to be jumping in and out of things all the time, and I just don't have the time to do it that way. But I was overloaded with oil stocks, and suddenly oil sold off yesterday. I don't want to see this current value of the portfolio dip down below 100,000 again. I just got back above it, and so like BTU. Now, these are pretty subtle signals here, but BTU, let me go to the candles here. You can see this a little bit better. BTU is going to close below the low of the previous day for the first time in a while, just coming off of testing the previous high. And so, again, there was a good chance it was going to drop again today, and it did. Now, you have a bullish reversal candle here. I could consider jumping right back in it again, but I think I'm going to wait just a few days to see what kind of happens with this ceasefire talk, because I think it could possibly come down a little bit further if that does take place. OAS, same thing, and this one was clearly closing below the low of the previous day. Same thing happened. It gapped down and had a little bit of a bullish reversal day today, but I went ahead and got out of that one. And again, like I said, I might jump back in it sometime this week, but I didn't want to give back the profits I had made up to that point. CLR. Now, CLR didn't quite close below the low of the previous day, but because so many of the oil stocks did, I figured that one was probably going to act the same way, which it did. It got down today and moved lower. I just cleared out all of those. I also got out of the defense stocks that I was in, RTX, same thing. It was going to close below the low of the previous day. Again, these could be ones I might jump back into again. Well, I'll definitely be jumping back into again because I think they have a lot, longer to run. And the reason why I'm not talking about jump back into them again today was we just got done to look at the whole market update, and there's a good chance we see some sort of a pullback in the near term in the indexes. I don't want to be, if that is going to happen, I want to let it happen before I jump back into these things. So, and then LHX had a bigger drop yesterday, and just looked like it was maybe in a wave C. Maybe this is wave A, wave B, wave C. Maybe it could come down here a little bit further, although it has a little bit of a hammer formation today. But typically when you have just a quick drop at a hammer formation, they don't always work as well. But anyway, so out of the positions I'm still holding, I'm still in NVIDIA. I do have some decision to make though here, because NVIDIA has it's trading lower than where it opened, but higher than the day before, just like the whole chip sector is right now. It's looking like in the near term it could pull back a little bit, but I think I'm going to go ahead and hold on to this one just because we're a lot further off of the highs on some of these stocks. So if they pull, because all this is saying it should pull back a little bit in the near term. I don't mind if it pulls back into here or something and then rebounds again. I kind of want to see what the indexes are looking like over the next day or two. So I think I'm going to hold off on just bailing on that one. And then Tesla, it's had this one's tough because we're at the far right side. I'm going to have to make a judgment call on this at the end of the day, because we're at the far right side of the extreme reversal risk and we're getting a bearish reversal candle. I might be bailing on that one. In fact, I'm going to just go ahead and bail on that one. I can always get back in it again, but we've had a nice gain there. I don't want to give back any of that nice gain right there. And I think if we do get a pullback, I can re-enter again on a little bit of a pullback and jump back in it again. So let's go ahead and get out of this one. And I could just wait till the end of the day here to make that decision, but I'm going to go ahead and just do it right now in case I forget. Current price is 10. So I'm looking right here. Current price is 109946. 1099.46. So I have a nice little almost $850 profit. No reason to give that up. We didn't have a big position anyway, so it's not like it's going to be the end of the world to do that. Question, do I put more weight on the actual stock chart or the indexes? I put weight on both. I'm not saying that if the indexes could pull back, that some stocks can't go higher, but from a probability standpoint, the majority of stocks are going to follow the indexes. And so when I see in that scenario there where Tesla's extremely overbought and the Qs are showing a bearish reversal candle and this stock is showing a bearish reversal candle, there's just a pretty high probability that it's going to pull back. And remember what I said earlier. Let me pull up Tesla again. Even if it does go a little bit higher, even if I didn't get the exact top right here, because sometimes it'll give you a bearish reversal warning and then try one more time to go higher and then pull back. So this may not be the exact pullback point, but it's usually pretty close. And you got to ask yourself, do you stay in it and try to get that extra dollar versus the risk that this thing could drop quickly and you're giving up $3 or something? It's just, and maybe I had this happen before in Tesla. I don't know if you remember, some of you have been around for a while, but it was back in here, I think. It might have been right here where we got a bearish reversal candle. and then it just kept going. It was already overbought, as you can see, and then it kept going. Same thing could happen here, but for every time it does that, there's probably 10 times where it ends up pulling back. So it's like, what do you want to bet on the rare chance it's going to go higher? And I think back here, even that the market, the indexes weren't extremely overbought, so they had some room to run, and I think that is what led Tesla to continue to run there too. So yeah, I consider both. But there may be times where the individual chart still looks fine. It's not extreme, and the market looks like it could pull back a little bit. And I might stay in the position because even if the market pulls back a little bit, I don't think that individual stock's going to pull back very much. It still looks like it's holding up pretty well or something like that. So I can't tell you that there's not a formula I have where it's like, if I see 1 + 1, it's going to be 2. I am, hopefully you know by now, I just gather information and then analyze the probabilities of the information I'm gathering. And that's what I'm trying to teach you is what are the clues I'm looking for? What are the clues I'm seeing? Because these are things that it's hard to teach a course around it. A lot of these things pop up, out of nowhere, and you're like, oh yeah, this is something I could teach you today. This is a bearish signal here, or this is a bullish signal here. And that's where that's why I hope the value of the classes is really is those unique situations that you're not going to typically design a course around or a book around or something like that, all right, and then the last one was Cloudflare. I'm going to still stay in this one just because, again, there's huge upside potential. If we do pull back, we're not really at a, well, I guess we are. I didn't think we were that, we're not extreme, but we are in the extreme range there, though. So, what can I do on this situation like this? Well, I could wait to see if we get a close below the low of the previous day. That's a very tight exit strategy. By the way, you usually don't want to do that by itself because stocks can close below the low of the previous day and still turn right around and run. But if you're in this extreme reversal risk, especially if you're on the right side of extreme reversal risk, that is a technique I like to use as a tight exit strategy. Because if you're extremely overbought, and then in the first time in a long time you close below the low of the previous day, there's a good chance you're going to probably pull back over the next couple of days, but this is a little bit of a different situation just because of the chart we come way down right here. There's a lot of I can see a lot of upside potential there if the market, because again, the market doesn't have, we don't know yet the market's going to drop. It doesn't have to. What if it does keep going on? I'd like to have some positions if it does keep going higher. So on this one right here, just because of it having pulled back a lot already and already kind of been consolidating through here, I'm going to wait on this one to see if I get that close below the low of the previous day, or a stronger bearish candle to consider getting out and see what the indexes do tomorrow. Do the indexes pull back just a little bit? Do they have a big sell-off and this big spiking or something like that? That might factor into what I do next on that one. But I'm going to go ahead and hold this. So I'm only holding 2 positions now. We'll see how that kind of plays out. Now in the watch list, ones that you could look, if the market does kind of stabilize right here and starts moving back up again. I like this MDTR. This is an oil stock. It's been kind of consolidating along here. Now it could still dip a little bit if the market dips. That's fine. as long as it kind of stays within this range right here, that's good. It'd be kind of nice if it could pull back into here and then hold right there. There's a breakout area too right there. Keep an eye on this one. And, if oil just turns right around and there's no ceasefire and it breaks out to a new high, you can buy a breakout on these as well. CLR was another one that I got out of this one, but there again, if it gives me another chance to get in, I may look to jump back into that one. USO, if you just want to trade the whole oil itself instead of oil stocks. Again, it'd be nice if it could come back down to here, come down a little bit lower, and then reverse. And then some of the other ones in the watch list. Some of these ones down here, BILL. It's moving higher today. It had this little bit of it. I got in this one, and it had this big bearish reversal day right there, which I didn't like right away, so I got out of it. But this one still looks pretty good. Again, I'd like to it'd look even better if we get a little bit of a pullback in the indexes here. Not a big dip or a big pullback, but more of a choppy pullback. And then this what is it, SYNA? Is that what it is? Yeah, Synaptics, SYNA. I think we talked about this one, maybe wait for it to break out, and that's probably a good idea, because if the market does pull back, it'll probably stay in this kind of sideways range right here, but that's one to kind of keep an eye on, I think. All right. That's it. We'll see how things look on Thursday and see if get a little bit clearer picture of the stuff we talked about today, and kind of go from there. All right, everyone, have a great week. We'll see you on Thursday for the stock specific class. Bye now.